Period.
This is our chapter 17, financial markets. Jesse, Daniel, Joseph, Cole, Yasmin, Jaluka, and myself, Mike. The investment choices over lifetime. You can see by the chart stages in life what life is might or be like, risk level and why, and the need for liquidity and why. So for Tesla Inc., the Tesla stock over the years was about $3.84, which was the lowest in 2010, and their highest right now from January 8th was about $880. And from the chart below, you can just see the growth over the stocks over the years. The Tesla stock over time started by Elon Musk in 2003. It's an energy saving company. It produces electrical cars, solar roofs, solar panels. The level of risk, it has a medium risk leading towards low risk because it is becoming more of a reliable car and also popular in today's age. The liquidity is high because they make enough money where they can pay off their debts, and also it has an autopilot mode. It's a wise investment because Tesla's most recent earnings report included the most ever vehicles produced and delivered. It continuously grows in sales year by year. Tesla's Fremont, California facility continues to ramp up with the company upgrading the factory which produces the most for the company. New factories in Berlin and also Austin, Texas have begun construction. Companies that focus on green and emission-free technology will reap the rewards of tax credits for consumers and manufacturers alike. Due to Joe Biden's victory, Joe Biden plans to combat climate change points toward Tesla for opportunities.
A financial market is essentially a marketplace which provides a way for the sale and purchase of assets like bonds, stocks, and foreign exchange. This chapter tells us how to build home equity, which is a very important way to become consistently financially stable. The best way to increase home equity is by building a home rather than renting. And in 2006, the United States reached its peak equity of 13 trillion. This was an excellent number and represented just how many Americans were financially stable and in a good place before the economic crisis in 2008. In 2008, the number declined to 8.8 trillion. This number showed how millions of lives were affected and how many people had to change their long-term plans, which were their retirement, their future housing, and important consumption decisions. Not only were the little fish hit, pretty much every large economy in the world suffered a decline in the market value during this time. This chapter tells us why it's important to purchase homes, other financial assets, and when it's important to sell these assets. It also gives us insight into why the financial market and assets go through boom and bust cycles. Um, it's also important for smaller companies to know how to build their financial capital. Most of the small companies don't have the financial resources required for them to make other business decisions they want to make. A good way for these firms to get money is from outside investors that are willing to pay their own money in hopes of a return on their investment. Venture capital is also a form of private equity and is a type of financing that investors provide to start up companies that they see a long-term growth potential in. Another good way to raise financial capital is by reinvesting their profits, and this could mean purchasing new equipment, revamping their structures, and going into research and development. Another good way is to borrow money from banks, but this only really works out once the business is set and they have a credible source for the bank. They can also go into corporate, municipal, and treasury bonds.
So in 17.1, in this section, we learn multiple things, including the corporate stocks and public firms. In this section, we learned that a corporation is owned by shareholders that have limited liability for the company's debt but share in its profits. They have the ability to trade or sell stocks or a representation of a firm ownership. Those who buy these stocks are known as shareholders and split their stocks in shares as a group of stocks. 100 stocks can be considered a share. Three main questions one should ask when a large number of shareholders owns a company are: how and when does the company obtain money from its sale? What rate of return does the company promise to pay when it sells stocks? And who makes the decisions in a company owned by a large number of shareholders? So, for the first one, it would be when it sells its own stock to the public. The second one would be that a firm can make a direct payment to its shareholders called a dividend, or they can give them the price in which they bought it as well as selling them as a capital gain. And for the third one, the two groups who make decisions in a company owned by a large number of shareholders are private groups and public groups. Businesses businesses may often gain imperfect information, meaning that buyers and sellers in a market do not have full and equal information. The firm's founders have better information than anyone else and can debate whether the firm's is likely to succeed or not. If they put their own money into the firm, that means that they have the high belief in what they are getting themselves into. If it seems that profit is most likely to occur, more information on the firm will become available and financial capital will open up to them. Using financial capital means borrowing money from a bank or issuing bonds or stocks. This means that they sell their ownership to the public while their own firm is becoming known and growing.
How households supply financial capital. Bank accounts. Bank accounts is an arrangement made with a bank whereby one may deposit and withdraw money, in some cases be paid interest. In financial capitals, the bank is the financial intermediary. Bonds. An investor who buys a bond expects to receive a rate of return. However, bonds vary in rate of return, involving in some risk. Stocks. Investors buy stocks to have a good rate of return. An investor can make money two ways: through dividends and capital gain. Mutual funds is an investment strategy that allows you to pool your money together with other investors to purchase a collection of stocks and or bonds. Rate of return and risk levels. The rate of return is the net gain or net loss of an investment over a period of time. To calculate the rate of return, you determine the percent change from the beginning of the investment to the end. Risk levels. A low risk level means at maximum you won't lose a lot of money you invested. A low risk level normally leads to a slow and steady rate of capital gain. A medium risk level are more long-term investments with moderate returns. A high risk level is where the chances of underperformance is higher than average. And then this is just a graph that the government provides about risk level.
Housing intangible assets. Equity, the monetary value the owner would have after selling the house and repaying any outstanding bank loans used to buy the house. House investment is tangibly different from bank accounts, stocks, and bonds because houses offer financial and non-financial return in the way of housing services as a place for living and capital gain if you sell it. Some other tangible assets with the buy low, sell high mindset would be gold, silver, pretty much any precious metals, sugar, cocoa, oil, and natural gas. And then collectibles, these are things for return of services or higher selling price mindset, such as paintings, jewelry, antiques, baseball cards, things in that nature. And then tangible assets have a rate of return. The rate of return is moderate. The risk is moderate for housing and high for things such as collectibles like baseball cards. And the liquidity is low because of the time it could take to sell and the energy.
So here we have types of bank accounts. There are 4 types of bank accounts: a checking account, debit or credit card, savings account, and a certificate of deposit or CDI. So the checking account facilitates transactions by giving easy access to money, either by writing a check or by using a debit card. The debit card is a card which works like a credit card, except that purchases are immediately deducted from your checking account. So what that means is that as soon as you swipe the card, the money goes comes straight out of your account. Next, we have a savings account which pays some interest rate, but getting the money typically requires a trip to the bank or getting the money electronically. So you'd either have to go to Chase or your local bank or go to an ATM. And the last one we have is a certificate of deposit, which is a mechanism for deposit funds at a bank and promises to leave them at the bank for some time in exchange for a higher rate. Parents usually give these to their kids when they're born so that as they grow, the interest rate grows and the money grows. So here we have interest rates on 6-month, 1-year, and 5-year certificates of deposit. Interest rates on CDs have fluctuated over time. The high interest rates of early 1800s are indicative of the relatively high inflation rate in the United States at that time. Interest rates fluctuate with the business cycle, typically increasing during expansions and decreasing during a recession. So during something like the Great Depression, the interest rate would go down. And we have banks in summary. The advantages of bank accounts for financial investors are that it's easy access to money. Money in the bank account is very safe, and there's low interest rates. There's also the Federal Deposit Insurance Corporation, or the FDIC, which protects the savings up to $250,000. Banks are low risk, low return of rate, and they have high liquidity. And lastly, we have bonds. There's two types of bonds. There's the U.S. government treasury bond, which is an extremely safe borrower. It pays low interest rate. It has a high yield, or it pays low interest rates. And the next one is high yield / junk bonds, which offer high interest rates to compensate for the relatively high chance of default.
This is how to accumulate personal wealth. The question is, why is it hard to get rich quick? And that's really relating to why is it hard to get rich quick in the stock market? Because investing in stocks, it takes a lot of risk, especially if you plan on doing it for long term. And the fundamental problem with predicting future stock winners is that by definition, no one can predict the future news that alters expectations about profits. And what that means is when you invest into a stock, you're never going to know if the price is going to go up or down. And that's why it's hard to get rich quick when you're investing into stocks, because you could buy the stock at a really low price and you could either lose money or gain money. And the theory that comes with investing into stock is called the random walk theory. And again, because of that, the stock market prices, trends, or past movements can't predict the future movements. And the theory is just saying that predicting stocks is very unpredictable. It's very hard to outperform the market. And the reason it says random walk is because the stock price can rise or fall at any given day. Again, if you invest into a stock, the next day it could either go up 20 and the day after that could go like down 50. So you lose money in that case. And if you really want to try to get rich off stocks, it'd be better if you look at companies that have a brighter future. And another way to accumulate personal wealth is by getting rich the slow and boring way. There are mainly two ways you could gain large amount of wealth in your lifetime. The one way is to complete additional education and training. And the reason for that is because income tends to be higher to people that have a higher education. Now, lately that's been in question of whether if that's true or not. But if you look at statistics over the years, if people who have a college education compared to people who only have a high school diploma, people who went to college tends to have the higher income than the people with only the high school diploma. And then another way you could gain large amount of wealth in your lifetime is saving money early in your life. And so you could gain compound interest over time, which I'll get on later on. And the first type of interest there is simple interest, which is interest rate calculations only on the principal amount. And the equation for that is principal times rate times time equals interest. So for example, if you put like $100 into a savings account, you don't touch it, and you gain 5% rate, and over the 3 years, you gain $15. And it's not a lot of money, but it's still, you're just gaining interest over time. And the other type is compound interest, which is what a lot of people recommend you start doing when you're like at a young age. And that is interest rate calculation on principal amount plus accumulated interest. And the equation for that is future value equals principal times 1 plus interest rate to the power of time. So this example is, say you're 20 years old and you put $3,000 into a savings account and you just leave it there and don't touch it. For 40 years, you gain 7% interest over those 40 years. So you do that when you're 20, and 40 years later, when you're 60, you would have accumulated $44,923. And that is our presentation.